I want you to think about the feeling of silence after a loud noise. You know that moment when a thunderstorm has been raging for hours, shaking the windows, lighting up the sky, and then suddenly it just stops. The rain slows to a drizzle. The wind dies down. The air feels heavy and still. In that moment, your brain tries to trick you. It tries to tell you that the storm is over. It tries to tell you that it is safe to go outside, to take down the shutters, to go back to normal life. But if you have lived through a real hurricane, you know that the silence is a lie. The silence is not the end of the storm. It is the eye. It is the center of the rotation. And the wall of wind on the other side of that silence is often more violent, more destructive, and more surprising than the first half. We are currently standing in the eye of the silver market. We have seen the first wave of explosions. We have seen the price rip higher, waking up investors who have been asleep for a decade. We have seen the headlines scream about a new bull market. And now we are seeing the pause. We are seeing the pullback. We are seeing the profit taking. And predictably, the chorus of voices is starting to sing the same old song. They are saying it is over. They are saying it was a bubble. They are saying that if you didn't sell the top, you are a fool who is about to be left holding the bag. I am here to tell you that they are wrong. They are not just wrong about the price direction, they are wrong about the very structure of what is happening. We are not witnessing the popping of a bubble. We are witnessing the digestion of a meal. The market has just consumed a massive amount of liquidity, a massive amount of shorts, and a massive amount of physical inventory. It needs to digest that move before it has the energy to run again. And when it does run again, the fireworks we have seen so far will look like sparklers compared to the detonation that is coming next. Today, we are going to go deeper than we ever have before into the mechanics of this pause. We are going to dismantle the bubble narrative piece by piece. We are going to explore the psychology of why people sell their winners too early. We are going to look at the forgotten relationship between gold and silver that is signaling a massive second wave. And we are going to talk about a dark horse, a forgotten metal that is sitting on the sidelines, waiting to join the party and change the math for everyone. This is not a video for the short-term flipper. This is a manifesto for the person who wants to understand the architecture of the next 5 years of wealth transfer. Let's start by dissecting the psychology of the relief sale. This is the most dangerous trap in a bull market, and almost nobody talks about it. When an asset like silver goes vertical, everyone thinks the emotion they will feel is joy. They think they will feel euphoric, but that is not what happens. When you have been holding an asset for years, watching it go sideways or down, and then it suddenly rockets up, the primary emotion you feel is not joy. It is anxiety. You are terrified that the profit will disappear. You are terrified that the market will take it back. You look at the screen and you see a number that could pay off your car or fix your roof or clear your credit card, and the pressure to sell becomes unbearable. Not because you think the bull market is over, but because you want the anxiety to stop. You want to lock it in so you can sleep at night. This is why we see sharp pullbacks after big rallies. It is not because the fundamentals have changed. It is because thousands of humans are collectively exhaling. They are taking the exit ramp because the speed of the highway scared them. But here is the tragedy. The market is a machine designed to transfer wealth from the impatient to the patient. When you sell for emotional relief, you are handing your position to a buyer who has no emotional baggage. You are handing it to an institution, or a whale, or a hardened stacker who looks at the dip not as a terrifying drop, but as a gift. They take your position and they ride the next leg up, the leg that usually generates the life-changing wealth. We need to reframe how we look at this price action. Stop thinking in terms of a single outcome. The amateur asks, will silver go up or down tomorrow? The professional asks, what is the market structure telling me about the next phase? We have to prepare for 3 distinct paths, or routes, as we move forward. The first route is the grind up. This is the most likely but the most frustrating. The price makes a new high, then crashes 10%, scaring everyone out. Then it grinds back up, makes a slightly higher high, and crashes again. It is a stair-step pattern designed to maximize frustration. It shakes out the leverage, it shakes out the weak hands, but the trend line remains intact. If you are waiting for a smooth ride to the moon, this path will break you. You have to be prepared for the ugly grind. The second route is the stall. This is the boredom killer. The price shoots up and then it just stops. It goes sideways. It trades in a narrow range for weeks, maybe months. The volume dries up. The YouTubers stop making videos about it. The Reddit threads go quiet. This is the boredom shakeout. Humans crave dopamine. We want action. When the market stops giving us action, we get bored, and we sell to go chase something else. Maybe a tech stock, maybe crypto, maybe a meme coin. And the exact moment that the last bored tourist sells their stack, is usually when the market ignites again. Boredom is the fuel of the next rally. The third route is the punch in the mouth. This is the one you have to fear. This is where something breaks in the broader financial system. A credit freeze, a stock market crash, a liquidity crisis, and everything gets sold. Silver, gold, stocks, bonds. Everything goes down together in a wash of forced liquidation. But here is the key. In this scenario, silver is the first to rebound. Why? Because the fundamental shortage of physical metal does not change just because a hedge fund had to sell paper contracts to cover a margin call. If we get the punch in the mouth, it is the buying opportunity of a decade. It is the fire sale. If you are not mentally prepared for this, you will panic sell at the bottom. If you are prepared, you will back up the truck. Now let's talk about why this time is structurally different from 1980 or 2011. The bears love to pull up the charts from those years and say, "See, it's a double top. It's going to crash for 20 years." This is lazy analysis. It ignores the fundamental shift in how silver is consumed. In 1980, silver was money and film. In 2011, it was an investment vehicle. Today, silver is critical infrastructure. It is the nervous system of the modern economy. We are in the midst of a global energy transition that is completely dependent on silver. Photovoltaic solar panels are consuming a massive growing percentage of annual mining supply. And this demand is inelastic. I want you to understand that word. Inelastic means the buyer does not care about the price. If you are building a solar farm and you have millions of dollars invested in land, permits, and glass, you are not going to stop the project because silver went from $30 to $50. Silver is a tiny fraction of the total cost, but without it, the panel does not work. You will pay whatever the market demands. This industrial demand puts a floor under the market that did not exist in the past. In 1980, the Hunt brothers could be broken, and the price could collapse. Today, you cannot break the laws of physics. You need silver for electronics, for batteries, for missiles, for satellites. This demand is relentless. It eats inventory day and night, regardless of what the paper price on the COMEX says. We are seeing a divergence between the paper world and the physical world. The paper world is volatile, emotional, and manipulated. The physical world is tight, stressed, and desperate. When you see the price dip on your screen, but the premiums on physical coins stay high, that is the market telling you the truth. It is telling you that the paper price is a lie. It is telling you that the physical metal is scarce. Do not listen to the lie. Listen to the friction. Listen to the delays in shipping. Listen to the mints telling you they are out of stock. That is the signal. We also need to address the gold to silver ratio because it is flashing a signal that most people are misinterpreting. The ratio has compressed recently, meaning silver has outperformed gold. But now it is stalling. It is bouncing. And people are worried. They think silver has lost its momentum. They think gold is taking over again. This is a misunderstanding of how the relay race works. In a precious metals bull market, gold and silver pass the baton back and forth. Gold is the defensive player. It leads when there is fear. It leads when people are scared of the banking system. Silver is the offensive player. It leads when there is inflation, when there is growth, when there is speculation. When the ratio drops fast, silver runs hot. It gets overheated. It needs to rest. During that rest period, gold often takes the lead. It creeps higher, it stabilizes the complex. This pause in the ratio is not a failure of silver, it is a reloading of the gun. It draws in a different class of investor, the conservative, safety-first investor who prefers gold. Once gold makes a new high, that money starts to look for leverage. It looks for something that is cheaper, something that moves faster, and it rotates back into silver. This rotation creates a feedback loop that drives both metals higher but in alternating waves. Do not be discouraged if gold outperforms for a month or two. It is simply building the base for silver's next vertical move. And now, I want to introduce a character into this story that has been sitting in the shadows for a long time. A character that has been ignored, beaten down, and forgotten. That character is platinum. You cannot talk about the fireworks in the precious metals complex without talking about the potential explosion in platinum. Platinum is the sleeping giant. Historically, platinum has traded at a significant premium to gold. It is rarer than gold. It is harder to mine than gold. It is essential for hydrogen fuel cells and catalytic converters. Yet, right now, it is trading at a historic discount to gold. This is an anomaly. Markets hate anomalies. They eventually correct them. If platinum begins to wake up and we are seeing signs that it changes the psychology of the entire sector. It validates the scarcity thesis. If platinum starts to run, it attracts the value investors, the contrarians, the people who miss the move in gold and silver. It adds another engine to the rocket. But there is a specific reason why platinum matters for the silver investor. It confirms the thesis that real assets are undervalued relative to financial assets. We have lived through 40 years of financialization, where stocks, bonds, and derivatives were king. Now, the pendulum is swinging back to atoms, back to things you can touch. Platinum, palladium, silver, gold, copper, uranium. These are the building blocks of civilization. And they have been starved of capital for a decade. The mines have not been built. The refineries have not been upgraded. The supply chain is fragile. When the money tries to rotate from the paper economy back to the real economy, it is going to find out that the door is too small. There is not enough platinum. There is not enough silver. This is what causes the fireworks. It is the collision of infinite paper money with finite physical resources. We are currently in Act 3 of this drama. Act 1 was the stealth phase, where the smart money accumulated quietly. Act 2 was the awareness phase, where the early adopters jumped in. Act 3 is the excitement phase. This is where we are now. The media is talking about it. The price is moving. But we have not yet reached Act 4. Act 4 is the mania. Act 4 is when the public loses its mind. Act 4 is when people line up around the block at the coin shop. Act 4 is when the price goes parabolic. The pullback we are seeing right now is the intermission between Act 3 and Act 4. It is the market taking a breath before the final, most violent performance. If you sell now, you are leaving before the grand finale. You are leaving before the fireworks that you paid to see. But I want to be clear about the risks. I am not a prophet. I cannot guarantee the timeline. The stall phase could last longer than we want. The punch in the mouth could be more painful than we expect. The government could change the rules. They could raise taxes on metals. They could restrict purchases. They could implement capital controls. This is why you must have a plan that is robust enough to handle delays and interference. This brings us back to the concept of positioning. You do not want to be all in on a single outcome. You want to be positioned for probability. The probability is that fiat currencies will continue to debase. The probability is that industrial demand for silver will continue to grow. The probability is that the debt crisis will force the Federal Reserve to print more money. These are not guesses. These are mathematical certainties over a long enough timeline. So, how do you play this? You stop looking at the 5-minute chart. You zoom out to the monthly chart. You realize that the volatility is noise. The trend is the signal. You use the pullbacks to accumulate. You use the boredom to study. You use the digestion phase to get your own house in order. Are you overleveraged? If so, this pullback is a warning to de-risk. Are you underallocated? If so, this pullback is a gift to buy more. Are you emotionally unstable? If so, this pullback is a sign that you need to size down your position until you can sleep at night. The market will find your weakness. If your weakness is greed, it will wreck you with a correction. If your weakness is fear, it will wreck you with a rally that leaves you behind. You must find the balance where you can hold through the storm. I want to talk about the ghost in the machine. This is the algorithmic trading that dominates the modern markets. These algorithms are programmed to exploit human psychology. They know where your stop losses are. They know where the pain points are. They will push the price exactly to the level that causes maximum pain, and then they will reverse. This is why you cannot trade silver like a tech stock. You cannot use tight stops. You cannot use high leverage. You have to be a holder. You have to step outside the casino and just own the asset. When you own the physical metal, the algorithms cannot touch you. They can smash the paper price all they want, but they cannot force you to sell your ounce. You have removed the counterparty risk. This independence is the true value of silver. It is not just about making money. It is about declaring independence from a broken system. It is about opting out of the debt Ponzi scheme. When you hold a silver coin, you are holding the only form of money that is not someone else's liability. That is a powerful feeling. And as the world becomes more chaotic, that feeling becomes more valuable. We are moving into a world of multipolarity. The US dollar is losing its dominance. Nations are looking for alternatives. They are looking for neutral reserve assets. Gold is the primary beneficiary of this, but silver drafts behind gold. As central banks accumulate gold to back their currencies or settle trade, the public will accumulate silver to protect their savings. This is a global phenomenon. It is happening in China, in India, in Russia, in the Middle East. The West is actually late to the party. We are the last ones to realize that the paper game is ending. When the Western public finally wakes up, when the average American and European realizes that their currency is melting, the rush into metals will be unprecedented. There is not enough silver to satisfy that demand. The fireworks will come from the realization that the supply chain is empty. So, what should you expect in the coming months? Expect volatility. Expect confusion. Expect the narrative to flip-flop between it's a bubble and it's the future. Expect the experts to be wrong. Expect the price to do the illogical thing. But through it all, keep your eye on the fundamentals. Is the debt gone? No. Is the industry using less silver? No. Is the money printer turned off? No. Then the bull market is alive. The digestion is healthy. It is building the energy for the next leg. Do not let the silence fool you. The storm is not over. The eye is passing, and the back wall of the hurricane is coming. This is the time to batten down the hatches, secure your position, and wait. When the wind picks up again, it will lift silver to levels that will seem impossible to the skeptics. We are talking about triple digits. We are talking about a fundamental re-rating of the metal. We are talking about silver returning to its historic role as money. But you have to be in the market to benefit. You cannot watch from the sidelines. You have to have skin in the game. And you have to have the stomach to ride the roller coaster. The fireworks are not just pretty lights in the sky. They are the explosions of the old system dying and the new system being born. Silver is at the center of that birth. So ignore the noise. Ignore the people telling you to sell. Ignore the boredom. Stay focused, stay disciplined, and remember that the biggest gains come to those who can endure the hardest waiting periods. The digestion phase is where the weak hands leave and the strong hands feast. Which one are you? This is the moment of truth. Not when the price is going up every day, but when it is going sideways. This is where you earn your stripes. This is where you earn the right to participate in Act 4. Hold the line. The show is far from over. In fact, the main event is just getting started.